Hello, good evening. Welcome to this month's webinar on investing through the ages with myself, Michael Holliday, the investment manager of residential estates. To my right, we have two of our investment consultants, Chris Smith and James Davis. Hi guys, good evening.
Hi, good evening.
And to my left, we have one of our business development managers and head of resale property, Andrew Brassey.
Good evening.
For those of you that hasn't joined us on a webinar previously, we like to keep these as interactive as possible. So you'll see on the right-hand side of your screen there, there's the chat section. Please do pop up, say hello, let us know where you're watching from this evening. I know we have quite a lot of overseas clients, so maybe you're watching in somewhere sunny abroad. Let us know, or somewhere else in the UK. We'd love to hear from you. In fact, we've got quite a few popping up. Maria, hello. Peter, hello. We've got Tatiana, Melanie from London. Rajesh from Bournemouth.
I know Parash is there as well. Hello, Parash. Hope you're well.
Great to see you all. So we'll just give it sort of a minute, so just to allow everyone to get on. So yes, please do pop up. There's Parash. Good to hear from you, Parash. And we'll just watch over you. Hi, Wickham.
Bristol.
Bristol.
Yeah, Bristol, my neck of the woods.
Your neck of the woods, James.
Family member, James?
No.
Great stuff. So, right, we will get on with things, but thanks very much for popping up. And like I say, use that section as much as possible this evening. Any questions, or if you disagree with something we say, any opinion you've got, feel free to jump up. We want to hear from you throughout it. So, yeah.
Jabbar from Dubai.
Yeah. Great stuff. Right, we will get on with things. A lot to get through this evening. So, firstly, we're going to look at why people invest in property. So, what are the main drivers that people choose property to invest into? All four of us have invested in property. A lot of our clients have, so we'll talk through the main reasons of that. We'll then look at who invests in property, and we've got some really interesting stats, haven't we, as to
we have indeed.
How that's changed over the last few years, the different ages of people that are invested in property. So that's one thing to look out for as we go through it this evening. Then we'll get on to the main event of the evening, what we've labelled as investor top trumps. What that means is we've got some example clients, their backgrounds, what they're looking to achieve from property, and what we think would suit them. So what are the property sectors we think would suit them? Almost a live consultation. It's that point we want you to jump in as much as possible. You know, tell us your backgrounds, what you're looking to achieve, and we can almost do a live consultation with you as well. So we've got that, and then we'll round things off. We're just looking at things to watch out for, the do's and don'ts, if you like, of investing in property. I'm delighted to say as well, we're joined by a very special guest speaker. We've got Adam on from DNA Financial Solutions, who is a broker we have worked with for the last 2 years now.
Could be a bit longer.
Yeah, maybe a little bit longer. And he's helped a lot of our clients finance some of the properties that they've purchased with us. Some of you on this evening watching, perhaps you've used DNA or are currently using DNA. So Adam, thank you very much for joining us. Good to see you.
Thank you. Yeah, thanks guys. Good to be present. Thank you.
So I didn't know if you just wanted to give a quick overview, Adam, of yourself, just to put people in the picture of who you are and a little bit about DNA.
Yeah, absolutely. So we are a specialist finance brokerage, so multidisciplinary. We do have access. We can probably touch on it a bit later, actually, to master broker status with a couple of lenders. One of only, I think, 35. Don't quote me on that, but it's somewhere in the region of that. So yeah, we specialise in all things property advice and particular skill sets within the buy-to-let and property investment sector, which you hopefully you'll get some benefit from this evening.
Yeah, and we'll come back to you quite a lot, Adam. We've get your opinion on as well on that as we go through it.
Absolutely.
So let's kick things off as to the main reasons why people invest in property. We put some forward there that you can see on your screen. But guys, I mean, all four of us, like we say, have invested in property. Particularly James and Chris, on your side, what do you see as the common things that come up from clients as to the main drivers that they choose property to invest in?
Yeah, I think for me, and I know, thank you for my clients as well, firstly, for joining. I can see a few of you have joined, so thank you for that. And I'm sure, being my client, you'll know our conversations we've had personally. But from my feedback over the last, investing's changed quite a lot, to be honest, over the years, especially with my experience being involved. People are more, from my experience, looking at more returns. Something to, obviously, properties to create cash flow, whether that's for now, to enjoy now, or even as well as buying property, one, for example, holiday lets or short-term lets, one as a return, and secondly, to use themselves. We all go on holiday. I've got children. I know a few of my clients on here on the chat have got children as well. But it's quite changed, not just, the typical buy-to-let property. It's the strategies, quite a lot of strategies out there at the moment.
Yeah,
So,
and I suppose there's long-term goals, there's short-term goals. Short-term might be making that secondary income now, which we've seen a lot more people get into. Long-term might be looking at future, passing properties on to kids, like you've mentioned, Chris, with your family as well. So it's split up that way. James, I'm sure you've.
I think for me, if I sort of look at all my clients, I think the overall one is planning for the future. But I'd probably say pension is probably the big one, and that probably links into planning for retirement, but also a lot of clients helping out their kids for the future, helping them being able to get onto the property ladder. So I think it's the planning for the future, and that links into retirement. I think we're seeing less and less people with pensions, and I think.
And I suppose it's looking at what's the alternatives, Andrew. What do you put the money into instead? Stocks and shares, that type of thing. We've seen people move away, haven't we?
I think there's a raft of things you could put it into, as you say, stocks and shares, into derivatives, into there's quite a lot of modern or new types of investment. Whiskey at the moment seems to be having quite an upsurgence. Fine wines, possibly classic cars. If you look at some of the classic cars that over the last 10 years, some of them have
Bitcoin.
Bitcoin, indeed. I hold my hand up. I do not understand Bitcoin, but some people have made a phenomenal amount of money on Bitcoin, and who are we to sort of deride it?
I think on the flip side, a lot of people have seen people make money on property, and
very much so.
They want a piece of it. I think it's still seen as the most secure.
I'm of an age, and James, we can remember the financial crash of 2007 through to 11 maybe, and a lot of accidental landlords came into the market then. And I think what we've seen there is those landlords have come in, couldn't sell a house, job moving 300 mile away, let's rent the house I have, and thought, hang on a minute, this is quite a good idea. This is working for me. So let's maybe go and buy a second, refinance, and that's where Adam will come in. I'm talking about refinancing of existing property, maybe a portfolio that you own, draw more cash out to go and increase that pension.
I think for now, Mike, and I'm sure you can agree with me on with what we're doing at the moment in terms of investing or looking at properties at the moment. It's you can see it yourself. You go to the gas station, you're filling up your fuel. You see that rise up ridiculously. I think mine's gone up from £150 a month up to nearly £300 a month just for fuel. So these are things as well. People are starting to factor in inflation, the cost of livings. That's going up through the roof as well. So people are now starting to think, well, hold on a minute. Like for example, a pension. I can't really enjoy that money now. With a property investment, you can enjoy that money now, can't you? You can enjoy the growth.
And people living longer as well, aren't they? So I think people are thinking now. I don't know the stats for the average, but you probably go back 50 years ago, it's probably gone from the average age of late 60s, 70s to sort of in the 80s now. So people are starting to think, well, is my pension going to be enough? Is it going to grow enough to support me and, potentially help the family
and can you rely on the 9-to-5 jobs? Unfortunately, during COVID, a lot of people lost their jobs. And it made a lot of people think, didn't it? Well, I need a backup here. I can't just have that. I want a secondary income on it.
We touched on that, didn't we? Lockdown has forced people to sit at home and think about
and reflect
on life. What are my habits? Where are my spending habits? Well, I think I've done the same. I've looked through my expenditure per month, thinking, well, what can I cut back on? You know me, Mike. I'm
not terrible. Much is the answer.
Yeah, not much. My cost of living
is always last in the bar, isn't it?
Yeah, he is. Yeah.
I think James touched on it there. The pension. I think as we get older, we're having to work longer, and I think. Again, you mentioned COVID, lockdown. It has, I think, given people time to reflect on what their life is at the moment, and do I want to work until I'm 70? I think people who are sort of more maybe 25 today, are they going to be looking at 75?
Yeah.
So how can I generate a maybe not a secondary income, but an income that will allow me to retire at 60 and enjoy life.
Yeah,
you know?
or go part-time.
Or go part-time,
Yeah,
yeah.
and
career
Parash,
change.
Parash is making a really good point there. I think what he's indicating too is the property life cycle and how over time property does go up. Yes, there can be dips. You mentioned it, Andrew, in 2007 there was a dip, but it still went up over time. And you saw it with your own property, didn't you?
Oh, James, yes. I bought an apartment in Manchester, 2007. And talking about sort of accidental landlord, you know, I've invested in property since 1986. But we bought the apartment in Manchester for my daughter to go to uni. And within a year, I paid 130, paid 130 for it. And within a year, it was probably worth 100.
Yeah.
Today, it's worth 175.
Yeah, exactly. Yeah,
And as long as I've spoken many times in presentations about the growth of property and the value that property can add, but it's very much about making the choice when you want to sell it.
Mhm.
If I were forced to sell it in, say, 2009, I'd have been looking at a 30k loss.
Yeah.
If I sold it today at my choice of selling it,
Yeah.
I'm looking at potentially 45,000 gain.
Yeah.
So I think it's very much don't stretch yourself. Talk to the likes of DNA. Talk about the mortgageability, the affordability.
Don't look at it short.
Yeah.
It's not
Don't look at
short term.
short-term.
It's
And
not short term.
I bet there's loads watching that. I've got some great stories on that as well.
Oh, James,
Probably
yes.
people that have invested in the likes of London, you know, decades ago,
Oh, yeah.
you know, how well they've done. So
Yeah.
let us know. I'm sure there's some really great stories out there on it. So we will move on. So this is an interesting stat. So these are the main reasons why UK landlords rent their property. And you can see you touching on, Andrew, people choosing property over the likes of stocks and shares. James, you mentioned about the pension. I know, Chris, you touched on it as well, as people seeing it as a job as well. Adam, just to bring you in, I know you were quite passionate on this, weren't you, as a job one. You've seen a lot of that, haven't you, of clients looking at it?
Yeah, there's been a noticeable shift with myself and a lot of clients that I'm tending to find, probably on average once a month, their sole focus is to not just have a passive income, but to actually move away from the proverbial rat race and get out of a stressful corporate environment, more into you touched on it on the previous slide, to be your own boss and that type of thing. So I think it is happening. It is achievable, with the right strategies, etc., and the right rental yield. So yeah, it's an interesting stat, and I can see that 10% just continuously increasing year on year, in all fairness.
I think, if you look at that as a job side of it, there's a lot of programs on television there about property, location, and there's hundreds of them. But if you look at some of them where maybe someone, they have maybe some wealth behind them, maybe from London, and they've gone into the country, they bought a nice farmhouse with maybe 3 or 4 acres, and they've put on holiday lodges, 2 or 3 cedar wood type of accommodation. And they're now creating that as their job. So you're generating that income from the land you've just bought. You maybe, there's one on the market at the moment, it's got an alpaca farm with it, and they do alpaca walking. So they're generating, coming away from maybe finance, they were in the city, and they're now creating their own.
I think that almost goes back to the pension pot, doesn't it? Because if you've got your pension pot, if you've got 500, 600, 700,000 million in a pension pot, you can't really do anything with that. Whereas if you've got it, if you've got it in property, you can be like you say, go and get a gîte in south of France, and it gives you that flexibility, doesn't it?
And Shaquille's just mentioned there, he's bought 2 in Blackburn at 45,000 in 2016, and they're now worth 90,000.
Brilliant.
6 years later. Congratulations, Shaquille. You obviously bought really well. You obviously did your education at that point. So congratulations.
Not just that,
Fantastic.
if you look at the slide as well, which we'll show in a moment, as you can see, 9.8% growth in the last 12 months, which was obviously, we know lockdowns played a huge part in that, because obviously it paused the market, wasn't it? People didn't want to move. They had no choice, really, didn't they? I know, people, tenants and stuff like that, were moving around quite frequently.
People expected the worst, didn't they? How many people did you have, Chris, that rang up when COVID hit and they were worried, weren't they? They thought it was going to get the other way around.
Well, Parash is a long-standing client of mine, probably right up there with one of my top clients. And people not aware of him. I'm sure people. He's there on the chat. But I had a chat with Parash about it as well, and we were looking, 2-3 years ago, talking about Brexit, talking about the elections, talking about COVID, and I think it's. Well, I think when you look at investing, especially for the first time, it is a bit scary, isn't it?
Yeah.
There are risks there. These are things that you've got to sort of weigh up over the time. But like you said, Mike, I've had it a lot.
Yeah.
We're going to see a property market crash after the elections. property market crash after lockdown, Brexit. It's still not come.
Well, the bottom line is, and I say it a lot, is we're a tiny island with a growing population, and that's not going to change anytime soon. The demand is huge, and that's why we're seeing stats such as that as forecast suggesting it's going to go by 21.5% by 2025.
Doubled in 6 years.
Exactly.
I think we've all got that example, haven't we? You know, you look at where you live currently, and you look around the corner. 200,000 last year, 225,000 this year, that sort of thing. And we can all see examples out there as to how the market is moving.
100%. Interesting stat there, Adam. I want to get your take on it, of the fact a lot of people are buying with cash. We've seen that as well, but I suppose it doesn't tell the full story, because a lot of those people, I'm guessing, are refinancing some of their properties at the moment. Are you finding?
Yeah, absolutely. That's it, and I think it's just the power of leveraging, really. And sometimes, like you said, it's worth having a chat of an educational piece to release some money from properties to acquire others and making it work for you. But I think you are right. A lot of that could be releasing money, sitting on it, and then seeing an opportunity come up. You know, like you said, with you guys, if a new scheme's come around and it's, you know, got a fantastic yield, they can jump on it quickly. So I think that does probably paint a bit more of a clearer picture in that respect.
I'm guessing at the moment when the market's so strong, refinancing is probably such a good option. If you can pull money out of one of your properties and then put it into a couple of properties, you know, mortgage them up. I know I've tried to persuade my wife, but she's having none of it. But I know it's a good strategy. I know it would work. It's just
but it's quite simple maths, isn't it? You know, so you can borrow at 3% and get 7% return. 7-8%.
That's it. It's all about the margins, isn't it?
Someone else's money, aren't you?
That's the key thing. Use someone else's money.
Yeah, exactly. Yeah.
I think Adam, we will be in touch, me and Mike, at some point, because we're always having debates in the office about remortgaging our properties. We might start someone to answer to, which is obviously his wife. But I'm more.
You're free that way.
I'm a lot more flexible. So.
Absolutely. No, look forward to it. Look forward to it.
Great stuff. Right, let's move on to the next slide. So let's have a look at who invests in property. Everyone. We're not just going to leave it at that. That'll be a very quick answer to it. But it's true. We're seeing a wide range now, aren't we, of different people, different ages investing in property, hence the name of this webinar. And this is a really interesting stat. So you can see here the number of UK landlords aged 40 or below, how much that has risen from 2018 to 2022. We're now up to 47% of landlords invest in property age 40 or below. That's a huge change, isn't it?
Massive.
And that's probably no shock to you two, especially because you've seen that come through with the inquiries, haven't you, people?
I think it's not a shock, but it's a shock when you see the stat.
Yeah.
When you see, because that is huge, isn't it? The jump. Yeah.
Well, it's like I was saying to you, Mike. We were saying this a couple of months ago, weren't we? That there's a huge jump at the moment. You know, anyone was sort of between 20, 35. We sort of seen. We've had a few students in as well, where they've ever inherited money. I think when we were touching on it, the savvy thing to do, maybe in the 90s, early 2000s, was to buy a flash car. And things like that. But people are starting to see, Tesla coming out with electric cars. Seth was going obviously about the economy and things like that at the moment. So I think people, especially the younger generation, are starting to think of the future. It's becoming
more savvy.
I think maybe the internet, that facility to look at what they're doing. Apart from during the lockdown, you bought a car, drove it out the showroom, and what did they say? 10% straight away. Buy a house, rising market.
Make 10%.
But you make 10% the first couple of years on it.
And I think younger people now see it as more trendy, don't they? But like you mentioned, it's not just about buying a flash car now. It look good having.
Well, a good example is you, Mike. You got the one. You got your trend. You're getting there. You're getting there. You got the one in Chester, which is a great investment for you. But you also, like you say, you use family. Your family's in Cumbria. They come all the way down to Chester. So it's things like that. It's twofold. Obviously, we get the perks of residential estates that can manage it for you. Use their contacts, which I'm sure we all do.
You might want to answer that, Adam. Maria's just popped up asking, how does refinancing property work? You'll answer that much better than I would.
Yeah, absolutely. I mean, the simple answer is obviously with an existing property that you have, depending on if there's a mortgage on it at the moment, we'd obviously look at what the value is. If you've had that mortgage for a while, has the value increased? There's probably a good chance that it has after the sharp increase last year, as per the previous slides. And it's about utilising that. So there's different methods. We can either do a straight up remortgage. So a first charge, you know, you go to a lender, they swap the finance out, for want of a better phrase, and that's it. You take the first charge mortgage. Or if you already have it and you're tied into what's called early repayment charges, we can look at other alternatives such as a second charge, which will allow that first charge lender to stay in place and have a top up of whatever amount you can within the loan to value parameters. So there is flexibility surrounding that in terms of refinancing. So there's more than one way basically that you can do it. Whether it be your own property, so it'll be a residential or regulated mortgage as it is in the FCA's eyes, we would have to assess affordability and income, and there'd be certain parameters that would have to follow for that, such as affordability models, etc. If it's a rental property, it's slightly different. We have lenders that can lend without any minimum income requirements. So even if you're not in work, or if that's your full-time profession, as we've touched on, we should be able to refinance you pretty simply on that basis. And again, your credit comes into the mix. So I know it's a bit of a wishy-washy answer, but obviously it's quite a broad subject that we'd touch on as a one-to-one conversation.
100%. I know Tony's mentioned there about the cost for materials and labour going up. We've certainly seen that, haven't we?
Oh, we have indeed, yes.
But with that, Tony, that's in a way it's pushed up prices of property, which a lot of people have then benefited from that have invested in property. So I can see the potential negative, but there's certainly a positive that's come out of that for certainly a lot of our investors on it as well.
Well, I mean, touch on that as well, Mike. I mean, obviously, a lot of my clients being on it, they're fully aware. Obviously, we negotiate like with developers, and we obviously we package everything up for our investors. So for us as well, it's making it difficult for us to drive that bargain on these developers because they're fully aware. You know, the cost of materials are going up, which you're right. It's got to come from somewhere, hasn't it?
Yeah.
They've got to put it on the property price. So it is making it difficult on that way. It's something you just can't stop. The market is going the way it's going. We can't see them slowing down anytime soon anyway.
No.
In terms of the prices. Again, it depends on cities, doesn't it, where it is.
Of course, yeah. It's demand, isn't it? That.
I don't know. There's a few questions coming up there.
Yeah, I was going to say, if you don't mind, guys, I'll just jump in, Maria. Yes is a simple answer. Absolutely, you can refinance a property that's paid off. That's something that happens quite a lot, to be honest with you, because it's really straightforward to do. Usually, a remortgage can be carried out from start to finish in 4 weeks. It can be less than that. The fastest I've done it is 2 weeks. There are lenders that can offer free legal service, no product fees for the lender, and even cash back in some instances, and free valuation. So it could actually be completely cost-free to do so, and still, obtain a really, really good rate. So yeah, it's a simple answer to that one. Yeah. Peter, what term of mortgage can I achieve as I'm older 60?
Great question, that, isn't it?
It is a fantastic.
The other day on that, of how people slightly older now can achieve mortgages, particularly on the buy-to-let front.
100%. It's actually on both sides. So if it's your own residential property, we can usually take it up to probably age 90 with certain lenders, the specialist lenders within the smaller building societies that can do that. Your high street lenders aren't necessarily going to do that. They'll probably take you to 75. So if it fits within that, there's other strategies. For example, we could look at an interest only basis that people aren't aware of, even if it is a regulated or a property that you live in. And on a buy to let, we had a bit of a laugh about it, because there is a lender that can, as long as you're before the age of 80, they can take you to what is in essence a 35-year term to 115 years of age. So if you live to that age, fair play. You've done all right for yourself, haven't you? So in a nutshell, you can take long-term still on mortgages, whether it be buy-to-let or residential.
But it helps with value of properties, doesn't it, from a resale point of view as well, when you're coming to sell it to other people.
Yes,
it's opened up that market now, hasn't it? It's literally like the name of this webinar. All ages now can invest in. There is no cut-off point.
No.
Absolutely.
No. Yeah. I think is the minimum age 18. So if you've been fortunate to come into an inheritance at 18, you can obtain a mortgage, use the inheritance as a deposit.
Yeah. I'm sure Adam would agree as well that the market's becoming so competitive, isn't it, Adam? In regards to even short-term lets, holiday let properties. When we were doing this 4 or 5 years ago, it was a little bit, the rates were all over the place.
Yeah.
So
Oh,
Yes.
it's unbelievable. The shift in the holiday let market mortgage space has been unbelievably good and positive in the last 2 years. The amount of lenders that have come back into it, and like you said, it drives rates down because there's so much competition. So the rates now in the holiday let space are as cheap as buy to let space, which is really, really impressive, because when they first started coming into it, there was a lot of skeptics. And I think the pandemic's helped massively because of the staycation hype, as they say. And I think more and more people are just starting to get used to wanting to remain in the UK and see the sort of natural beauty that we have within the country and the economy. So and boost obviously our economy. So yeah, there's a lot of demand now, and in that space, the holiday let space is a big one for the rates, and there's lots and lots of lenders coming into it, which is great.
Couple more
It's great to see.
questions just come in as well.
Yes, I've just seen that. Yeah,
Mentioned about the ground rent. It's a really good question. So we've
It's-
seen a lot now with our developments where
yeah.
we make sure developers make it less than 0.1% of the ground rent. So we're not seeing any new developments that we launch or any more than that, because it has affected people's ability
Yeah,
to
I
get
mean,
finance.
we've got a development at the moment in
It
Hull
has.
where initially it was £100. The prices were 95 to about 120. Came in initially on a 250-year lease with £100 ground rent. The developer looked at that and thought, well, tell you what, let's change that. 999-year lease, peppercorn ground rent. So even before as we were selling, in fact, we saw a shift in ground rent, and I think we'll see more and more of this.
And I think as well with you, Mike, it's a big part of your job, and then getting in early with the developers and being part of that, and making sure it fits.
They used to see it selling the freehold was a big part of their profits. Now they're just taking that out basically on it.
Which I suppose a lot, haven't we?
Yeah, we have, and some would argue that's maybe added it into the prices a little bit. Property that's probably forced some prices up as well, but it's certainly a lot better. Clients being able to mortgage properties.
Well, from Adam's perspective, it makes it so much harder. We've got some developments that were sold 5-6 years ago where the ground rent is probably 2%, 2.5%.
Outdated.
It's outdated, but the financial side of it is difficult to mortgage. There are, as I'm sure Adam will agree, there are the odd lender out there, but you might be paying slightly higher.
Yeah, you're right. There's the odd lender, but it's becoming increasingly difficult, if I'm honest with you, because they take up a lot of the lending. And then they then get nervous and want to pull out.
They hit the exposure level, don't they, Adam?
Yeah, exactly. That's the correct terminology. They hit the exposure level, and then that's it. It's all squashed into one, and then you're in an even smaller pot. So yes is the short answer, I suppose.
I suppose for you, Mike, as well, I bet it's become a bit easier when you're looking at these developments, because as a developer, I'm sure if anyone's thinking about development in the chat, these are things you've got to consider now.
Yeah.
If you're selling a project, if it's you can't get finance on it, and you can't get finance on it, you're never going to sell it, are you? So
no, exactly.
It sort of helped the market, and I suppose from a developer's point of view, raking up service charges, raking up ground rents, it's not going to do many favours, because he just won't be able to complete in terms of lending.
And it's improved massively, hasn't it, that market the last year or so on it. There's another question come through from Staffis. Good to hear from you, Staffis, and a really good client of ours. I think this one's again for you, Adam. He's asking about short-term let mortgages.
For overseas investors, it's an excellent question, and again, the simple answer is yes, which is always nice to hear. There's quite a few lenders in this space. As for the minimum property value, we could probably go as low as 75,000, if not a little lower. Now, you are going to pay a significant premium on the rate for that. I'm not going to lie to you. Probably circa 6-7% if you go that low. So to start getting some of the more sensible rates, as I'd like to call them, you're looking at £100,000 minimum valuation plus. So hopefully that gives you the answer. Average rate. And the rates on the interest only, and that is on an interest only or a capital repayment basis. The rates for that, it's hard to say this without personal circumstances, but usually between late 3s to late 4s. That's a general range that you'd be looking within. Yeah.
And it's a good question from Babs as well, asking about potentially moving their properties into a limited company. As far as I'm aware, there's no restrictions on you being able to do that. One thing I would say is, though, if you do transfer them across, I'm right in saying, Adam, that you would pay stamp duty on it?
Yes, that's the only issue. Yeah, it's the stamp and the potential capital gains. So I can't give tax advice because I'm not qualified to do so. So you should seek that. But yeah, they are the complications to it. There are some other ins and outs that I won't bore you with. But however, that's not necessarily true. You can leave them two in your personal name now and start a limited company SPV and start investing straight away for any future purchases. You can move them in, but it's whether it's going to be cost effective for you over the period of time that you'd look to own them for. And again, an accountant or a tax advisor will be able to give you a guide on that.
I think with every client of mine, especially the ones that are in the chat, that they'll be fully aware. I think the first thing you should be doing is looking at the strategy, the setup of it, setup, speaking to the right people, getting the right advice. Even before they come to you, Adam, about mortgages, or maybe speaking to yourself.
100%. Yeah, I think that line, and Babs has just asked it there, any advice on it, limited versus individual. I can give you the facts on an individual. The changes have now come into force that you cannot offset any of the interest against mortgage relief. So you are fully taxed on that. Whereas on a limited company, you can offset 100% of your interest payment against your tax bill or liability going forward. There's other bits and bats to consider, i.e. if you pay your own monies into your limited company SPV, again, an accountant will confirm this, but you will then have the monies in there to offset as a director's loan account, which again is beneficial in a tax point of view when you're pulling the profits back out. I think the limited company side of it is completely and utterly the way that the government want to force the professional route again now. They are wanting to stop ones and twos. So it will be probably sensible to consider limited company, but again, speaking to a tax advisor on that, they'll be able to give you a positive steer. But the shift has been significant into limited company over personal. I'd say 80% of our applications are in limited company now, which would dictate what is happening in the market at the moment.
And Adam, that doesn't create a problem on mortgage anymore, does it? You go back maybe 5 years ago, limited company, it would be a difficult scenario to obtain finance. Now,
it's exactly the same,
isn't it?
Yeah, it's literally, the application is exactly the same. There's no difference. The only difference is that you fill out a couple of extra forms, and you may need to do what's called ILA or independent legal advice, which is usually a cost of £150, £200, depending on who the solicitor is doing it. And that's the only difference. So because you offer a personal guarantee. So it's in essence, it is almost like lending to you personally, but it's just a loophole, in essence, to allow you to have a vehicle in a limited company. So the applications, there's no real difference. It's very, very straightforward to do, just like it is in personal name.
And Maria, I can see why you choose potentially the Northwest to invest in property. We've seen some really great areas, haven't we? Doing well. I'm just thinking on the top of my head, the likes of Preston's doing particularly well. We manage quite a lot of short-term let properties there. Well, I know our occupancy for the last month has been literally 100% of our properties. So, and it's perhaps an area, Preston, where you wouldn't have thought in the past short-term lets would necessarily do well, but the corporate lets, people working in the area, has really taken off. So that would be an area I would definitely consider looking at. Maria, anyone else?
I think with Maria, the question there in terms of like 2, 3, 4 bedroom, it really depends, Maria, on what your budget is. What sort of what you're looking for. Is it something that you're going to be using yourself? If it is going to be short-term lets? And have you done any research on that side of the market yet? You might be looking at this as a traditional buy-to-let. I mean, most investors are, aren't they? The old traditional, fashionable way of doing it is buying a house, renting it out to a family or a young professional. There's so many strategies out there, Maria. And I suppose, again, I know you've not gone into detail in terms of what you've put, but more in yourself. What are you looking to achieve? Are you wanting a property that's going to generate a high return? Do you need it to be hands-off, fully managed? But I'm sure we're going to get more into this anyway, Mike. Scenarios.
Shaquille's agreeing with us. Definitely deep early sales in Preston as well. Must be an area that he's doing particularly well in. Right, let's move on. So just some other stats as well. I think we touched on it about the expanding population. Now people are living longer, which is adding to the demand, adding to property prices. That's not going to change anytime soon on that front as well. So let's get into the main event, which is, as I said before, is investor top trumps. What we've done is we've put together a selection of case studies of people with different motivations as to what they want to achieve from property. And we're going to do a live consultation between the 5 of us just to discuss of what we think suits them, different property types. We're talking about student accommodation, short-term lets, holiday lets, standard buy-to-lets, doer-uppers, all those different ones of what we think suits their strategies. But as we said before, we want you to jump in at this point. Please do ask all the questions like you have been already. Tell us your background, and we'll try and do as many live ones direct with yourselves as well. So we will kick things off with this angry-looking builder that is divorced. Doesn't look happy about being divorced. But so, Chris, do you want to start things off on this one of how you would approach this client?
Yeah, I think for me, Tony came up in chat a moment ago. He said
Sorry, did I miss that?
He's a builder himself, so he could probably relate to this a little bit. I don't know where Tony is at, in terms of if he already owns property. For this guy, I'm going to call him Bob. Bob the builder, £80,000 cash. He's in rented at the moment, so he doesn't actually own a property. Will consider finance, and obviously has no properties to himself. Has that experience in terms of flipping. He's probably had ideas. We get it all the time, don't we? Whether from mates in the pub, do this.
People watching Homes Under the Hammer.
People watching Homes Under the Hammer. We get it all the time. Now, this is an area that, before I came to residential estates, I dealt with a lot of my clients dealing with repossession properties, auction type of properties, and sometimes attending these auctions myself, because I, sort of packaging them up as you would, maybe get a couple of quotes from different builders. I would say with, obviously, if you're going to bring Bob back up there so I can keep my eye on him.
He does a runner.
Yeah, in case he runs off. With Bob, it's clear to see he's a builder himself. I've got a lot of friends who do buying flips with cars, as an example. The mechanics themselves, it makes complete sense, doesn't it? Where I suppose I do get a lot of investors that I speak to who like this idea on paper, but once they get into it, like Tony said, the cost of materials has increased. So the sort of risks to this type of deal have gone through the roof. If you're not a builder yourself, you are trusting other building quotes. They always go in nice and cheap, when they go in there, price up the job that needs to be done. And then obviously you've got to weigh up your profit out of that as well. If the building costs start to increase, obviously the profit starts to diminish as well. And that's not to put doom and gloom on this model. For Bob, as an example, I'd probably tell him to stick with it. Yeah. Now, it's a massive risk, as you can see. He's got £80,000 cash. If that's his max budget, then this really needs to work out for him. If he fails on this first property, as you can imagine, he's probably going to be left with it. He'll probably be speaking to someone like yourself, Adam, in terms of a lot of people now these days are doing refinance models rather than reselling. Try to buy, do a bit of work to it themselves. And I suppose for the likes of Bob, his profit is in his work. He's going in there. He's doing the work himself.
While he's not working on it, then you've got to offset the fact that you're not earning, are you?
I suppose for the most successful people that are doing this are the likes of Bob, where the builders, they're in the trade. A bit like Tony, he's been in the chat before. He knows the ins and outs of material costs, things like that. And I suppose when he walks into a property, he knows full well what work needs to be done. To bring that up, it's not just going to be a lick of paint, is it? And we've seen it in auction houses now. It's more populated from first-time buyers, owner-occupiers as well. So what that's doing, it's actually driving the price up for these type of properties. People putting their own stamp on it, wanting to live in it for a bit, maybe.
Like yourself, Chris, I used to go to the auction to bid, and the first thing, the key at any auction, isn't it, is set your limit. So what is it worth to you? So you look at the property and think, it's going to cost me 20k to do. It's worth 90 done up. That's 70. I want 20k profit out of it. That's 50. My limit is 50. So you go into the auction thinking, I can go up to 50. Next to me, mum and dad, son or daughter next to them, 50. That's me out. Next thing, their hands up, 51, 52, 53. Because to them, it's worth 70. They're going to spend that 20k on it, and it's worth 70. So Bob has really got not a problem. It's going to be difficult to find that type of property. I think we spoke about it. James and I spoke about it just the other day. It's not just the cost of materials. Today, you've got additional costs, stamp duty, capital gains. That when I was renovating houses, I used to do an awful lot in the early 90s in Ellesmere Port. I didn't have capital gains. I didn't have tax.
Solicitors
costs, they went over my head.
I even think even years ago when I used to do it, you didn't have to pay council tax. I think now
Exactly.
you have to pay council tax.
It was empty for 6 months. Didn't pay
No,
council
didn't pay
tax.
to you, as long as you get it done within that period.
It's that hidden cost as well, though, which is time.
Yeah.
He's all right because he's in the trade, but if you're not, it's going to take up an awful lot of your time.
Yeah.
You know, a lot of the properties that we've sold and other people have, they're very hands off. They're taken care of for you.
I mean, obviously, for us, that type of property is a huge risk. You know, unless the deal's in black and white, it is what it is. This is the cost of the work. That's really when we're going to start getting involved. So although we can't help you right now, what I would say, for again going back to the successful scenarios, once he's done his first job and it goes well, fingers crossed it does go well, it's perfect for these investors to have properties like what we offer, fully managed in the background, generating a cash flow. Cash flow is key to this type of investment model. Just like our developers, these guys who are building 20, 30 apartments, going into sort of bigger schemes, they'll always have a portfolio of properties and diversify, whether that's student, short-term let, traditional buy-to-let, because the cash flow is key. If it does go wrong, you're okay.
And you said the other day, Chris, I want to get the first property right is key, isn't it?
You
get that right, you can then do more with it with the likes of Adam and things like that.
And I think bring Adam in there, I think, yes, Bob's looking to flip it, but if he's added value and added good value, does he need to flip it? Can he not retain it? And again, thinking of myself, some of the properties I renovated, I just flipped them. Made a nice profit. Thank you very much. But had I retained them, well, I probably wouldn't be sat here now talking to him.
Good job you did, didn't they?
Yeah, it is. You look at them and think, should I have just refinanced? Maybe taken a bit less of a profit, but refinanced, used that cash I've taken out on the refinance and gone and done number 2, number 4, number 10.
Yeah, I don't know. Jason Simmons has just backed up your point there, Andrew, on it about the rising cost of materials, auction costs, everything like that makes it very hard to flip and make good money from it.
And make good money. You'll make money, don't get me wrong.
Yeah.
I mean, the only way not the only way, one way to do it is to find that gem. Thinking of one in Heswall, we did Gospel View in Heswall. Well, just around the corner, there was a bungalow, fairly dated, 1960s. Guy bought it, demolished it, got planning for 5 apartments. He paid, I think, something like 400 for the bungalow. And then the GDV of the development is probably 2.5 million. He will make a tidy profit. But they're one in a lifetime, but they're one in every 5 years. But that's one way for your client, Chris, Bob, is to add additional value. Not just renovate it, but put a lofted conversion in, maybe put an annex on the back.
And it's important for someone like Bob to keep, what I would be saying to you is keep someone like myself or our company in your back pocket, because eventually you're going to need that second property. Once you've done what you've done on this one, more than likely it's a refinance job. He's going to return it. Keep us in your back pocket, because eventually you're going to need that property with high cash flow. And even if you were
just going to support your project, isn't it?
Even if you were looking at a property to buy and do up, maybe look at the areas or use the research. I mean, we've got a lot of guides on different areas that might give you a bit of knowledge. Thinking, well, hold on a minute, I could, I could do this, buy up and flip, or remortgage it, and actually use our services for managing it. Short-term lets, for example, to create that cash flow as well.
I think we'll also see that, Chris, is it's going to be an older property. In all probability, it's maybe, I would have said turn of the century, show my age now, but it would have been, say, 1900, not the 20s. Legislation has changed under EPC, so you have to put an awful lot more into energy efficiency, and that costs money. When I was doing it, even 2007, 8, just double glaze it, fine. Put your boiler in, fine. I didn't have to think about maybe cavity wall insulation or loft insulation, maybe solar panels on the roof. It all costs money, and it reduces the unfortunately the profitability of the deal.
And Jason makes a good point there about always looking to diversify your portfolio, and we'll mention that probably quite a lot this evening. We're not saying there's one route and you should just stick with that. You should have a good mix. It's what everyone should look
based on the individual, but also as well the diversification.
Exactly. On that. So right, let's move on to the next one. So this gentleman is married, 56, got a couple of kids, has 6 buy-to-lets already in London. So it'd be interesting to know, well, if we could find out when he bought those particular properties. James, do you want to have a look at this one?
It's quite a good one for me. I think with my daughter sort of approaching university within the next couple of years, I think probably you know, you'd have to look into more detail, but for me, sort of how I would be looking at this is, you know, this chap's got £120,000 that he's potentially saved up, and that's a bit of a pot to support his children through university. And I think I would look at this a couple of options really. You've got option one: does he potentially buy a property for his sons to live in? And I've seen lots of clients do that: buy a property, a 3-bed property for the son, and then the son rents the rooms out, which then supports the moderate university. So
maybe student then, James, with that.
So so you can look at sort of the student accommodation side. But I think probably the big one, what I would be looking at this is using that £120,000 to maximise income, so you've still got some money left at the end of the university period. Because if you're looking at £10,000 worth of fees, £10,000 on accommodation, it's going to cost you 120 to, you know, basic cost to put 2 children through university, as you know, Andrew. So it's using that money. So there's some money at the end of it. So you're almost getting other people, getting other people to support your children through university. You know, could you use that 120?
Again, it's whether it's short term or long term. If he's looking for a short term income, student might tick those boxes and use the cash up, get that income straight away on it. But if it's more long term, does he look to mortgage, leverage, and Adam will be nodding his head at that.
Just mentioned that by a 3-bed, thinking about what we have currently, like the Philadelphia Wharf, 3-bed apartment. Round the corner from Salford University in Manchester. Son has the main bedroom with the ensuite.
What would you charge? £500 about it?
You might get £400 a room. £800 coming in.
That's the fees.
Clears, you know, the mortgage payment on it. Happy days. And he's got the asset at the end of it. I think, you know, you were talking there, James, of the 120,000 just going on fees, accommodation. So effectively the 2 children have swallowed that amount of cash. But if he buys the rights, invests in property that the children can use whilst at university, possibly, it gives him an asset at the end of that 3-year term, or 4-year, depending on.
It would be interesting to know the 6 properties he has got. You know, all of them are managed. He's not managing any of those. I'd take a real keen interest in how those are performing, what he's used to buying. I mean, a lot of, like I said, it goes back to the traditional buyer. You know, I want to buy where I live. I want to. It goes to that, doesn't it? I want to buy where I live. I want to see and touch it. I'd be interested to see how that's performing and how that's working out for him.
And it would definitely be a chat with Adam as well to look at, you know, what equities.
Well, could you talk about refinance? Could you refinance those 1 or 2 of those 6 to increase the leverage of what he can spend?
And get a yield to pay for your children's education rather than your own money.
Just on a general term,
100%.
A lot of investors, don't we, from London these last few years? An awful lot of time. I'm sure there's some of you watching this evening. Let us know if you've invested in London previously or down south, and you're maybe now looking to invest up north, or maybe the other way around. Like I said, do let us know your background as well as we go.
You must be getting high salaries down there, Mike. I think we all need to relocate down to London. I know a lot of them are from London, and they are looking in northern regions because the property price is cheaper. It could be exactly the same at this type of client here now, where he's probably looking at northern regions, cheaper property prices, like Maria mentioned in the chat. You get higher yields, don't you? So it's about maybe then looking at regeneration areas as well. One, yes, return's great. But, you know, what's it going to look like in 4 or 5 years' time? You know, once they go on and leave you, I'm left with this property.
I think sometimes you've got to look at the vision, haven't you? That forward thinking about, you know, regeneration is spoken about a lot, but you know, Salford Quays, Media City, you looked at that in sort of 2010 maybe. It was a parking lot for a car dealership. Now it's a phenomenal enterprise, Media City, BBC, ITV, Channel 4. That network, and if you were first in there, I can remember standing, development was called Saltra, standing outside Saltra, pointing to the NV buildings across, saying, BBC's going there. And I'm sure people looked at me and thought, you must be joking. You look at it now, though, and the people who were early in have made a fortune.
And it's finding those places, isn't it?
It's sort of thing.
You have that, don't you? Then it's the next place, it's Manchester, Bristol, where I'm from. You have to your regeneration, and then it's finding that next place. What's the next place that's going to go? Because that spreads, doesn't it?
Yeah, we've looked at places like Halifax, haven't we, more recently? An area that maybe people wouldn't have in the past. You guys know it well, Adam. Halifax.
We do. Yeah, we're working on a scheme for you guys over there, and I think we touched on it the other day. Actually, there's a lot of money being spent in the Lloyd's building in particular. I think 37 million as they're consolidating 2 of their other buildings. They're closing down, which means obviously more jobs for the local town, more opportunities for staff needing them on a serviced accommodation basis or short-term let. So they would be a tremendous investment, as there is a lot of money. And Peace Hall, like I said, I know the town quite well because obviously where the head office is, but Peace Hall has had a lot of money spent there. So it's a really interesting place, and it is quite emerging because it is a little bit of a hub to jump onto the 62 towards Leeds or Manchester the other way. So yeah, it's a good place.
I suppose it's all part of the levelling up, isn't it, as they call it?
Yeah.
You know? And as long as there's works going on in an area, there's demand for short-term let properties, isn't there? If there's building works going on, they need accommodation to stay in.
I think for investors as well, you can get confused, can't you? You can so easily get confused. You know, if you go onto Google, you know, you'd see news reports, this is being regenerated, this is being planned. I suppose it's about contacting, you know, agents like ourselves, or reaching out to local estate agents as well in these areas and finding out what is going on. You know, there's regenerations happening all over the country, but how big is it? What impact is it?
And will it happen?
Will it happen?
That's
the big.
You look at Liverpool or Manchester. They talk about Liverpool waters, Manchester waters, Wirral waters. And when they launched Wirral waters, which is close to us all, £50 billion were they talking about? Admittedly, over 50 years. So far, nothing's happened. It's that investment that they talk about. You're actually going to see the hard cash.
The likes of Birmingham, don't you? Digbeth. We're already seeing the likes of Tesla and that moving there. So
that's like Hull with Siemens and the wind farm industry. You've got to find that driver.
Well, we brought up one, didn't we, last week in Kent, the Disneyland, new Disneyland. Disneyland plans were cancelled. Then they're obviously putting it in again. It just keeps, because obviously getting protests out there. Quite a lot of protests in Kent, and that's a huge development. If you know, as much as it keeps getting approved, it just keeps being knocked back from these protests.
Same as Warrington. We've got IKEA in Warrington. Next to it was going to be Amiga, and Amiga was going to be the biggest IT complex in Europe. Never got built. It's now a massive warehouse, and the Huck Group, or what do they call themselves now? It's not the Huck Group, it's just their initials, isn't it? The Huck Group have somewhere 1 million square foot of warehousing.
And I suppose that's where it's our job to make sure developers don't price things up based on what's coming in the future. Price it on now, and we sell it to investors.
It's the same
and
with
then
Kent.
They benefit from the future.
The big example was Kent. You know, it's all been priced on this new Disneyland, and then all of a sudden it's not happening. Obviously, they will put in the planning again. And a lot of money behind it. But if it keeps getting knocked back, you're not getting any effect. So you're right. You know, making sure they don't price it on those things.
On hope value.
Exactly. Sorry, Peter, you've asked a question for Adam there about what amount of time you need to be in trading before you can raise a mortgage in a limited company. Can you answer that, Adam?
I can. It depends if it's a trading limited company or if it is set up as a fresh SPV. So special purpose vehicle, as it's referred to. If it's a special purpose vehicle, you could do it day one. So you can set it up on company's house. 48 hours later, you've got it registered with your company number. You can literally do a mortgage application that day. So it can be instantaneous. If it's a trading company, it's a little different because it's whether we go down a commercial mortgage route or whether we, there are some lenders that can lend to trading limited companies. It just makes it a little more difficult. But yeah, if it's an SPV, and again, if anyone wants to ask me questions down the line or outside of this, they can do on that. But hopefully that gives you a bit of clarification, Peter.
Oh, that's great. Anything else you want to add, James? On
no, I think it's really Mike. All good.
Babs has just popped up. Should you always refinance instead of paying up a mortgage on a buy-to-let? Sorry, I don't know you.
Oh, it's all right, don't worry.
But you're the right man for this to answer again.
Yeah, it's fine, no worries. Should you always refinance instead of paying a mortgage on a buy-to-let? It depends on your strategy. I would always say yes, but again, it's open to interpretation. I personally, I think leveraging is key, because I think if you leverage a buy-to-let, it's almost like a monopoly board. That's the way that I describe it. If you leverage, you could buy a lot of smaller properties and you diversify the risk. So if you had a £100,000 properties and 2 of them didn't have any tenants in, or you had a rental void, you're not really going to feel the pain. Whereas if you had 2 £500,000 properties, one of them had a rental void, it's going to be significant to your income. So I think for me, Yeah, I agree with Jabir there. I think my answer is yes, you should always leverage, because you can make that money work for you, and you can buy more and more properties, which means more and more income, of course. And it's just a margin thing then when it comes to it.
You're actually making me want to remortgage now, Adam.
Oh, excellent.
About it, yeah.
You're not getting no one on this, Mike.
Yeah.
We spoke about that before, didn't we, James?
Yeah.
Use someone else's money.
I think they call it OPM.
It is using someone else's money is key.
OPM.
Absolutely.
Great stuff. Right, let's move on to the next card. We kind of touched on this earlier, Adam, didn't we, when someone asked the question? Normally speaking, when we would look at this type of client that would come through at this particular age, we wouldn't even dream of talking about potential mortgages, but the market has hugely shifted as we touched on. And because of that, that's opened up the options for the likes of this lady as well, hasn't it?
Yes, absolutely. And I think you guys touched on it as well, for yourself, Mike, with the family coming down from Carlisle. I think at this age, with the cash in the bank and buying, a short-term let property, I think it's really strong for them, because family can use it, depending on wherever the area is, they can all enjoy it, with grandchildren and all that sort of, situation with your family. So ages have shifted massively in mortgages. So yeah, the sky's the limit, really.
Would you say as well, Adam, for children to get involved almost in the decision-making process of what property to look for? And, we'll touch briefly on inheritance tax and the amount of money that's lost, if you like, on that. If you can bring them in earlier, the children, and what would maybe suit them, like you say.
Absolutely. I mean, without going into too much detail, obviously writing things into trust that we can explore and that type of thing. Obviously, you can mitigate concerns regarding inheritance tax and that sort of, for the survivor. I think it's 6 or 7 years from memory. Again, tax advisor will be able to touch on that with you, but absolutely, it's a big decision, and I think the family can be play a big benefit in that decision.
I think I'll qualify that. We hear so often, Adam, that 73-year-old lady wanting to invest, wanting to generate an income for herself. And I think sometimes we do see maybe the child saying, is this what you really want to do, Mom? Is this the right way to spend your 90,000? And I think that's why involve them. But take the emotion out of it. It's an investment that you're going to create an income from, and for me, I think for that lady, I'd be recommending she bought something completed to give her that income from day one, to give them the children the knowledge and the security that it's an existing property. It's there, it's bricks and mortar. She lives in Llandudno. She probably knows the tourism for Llandudno very well. Go and buy a furnished holiday there. Get the tax benefits of furnished. If her children live in London, as your family do, Mike in Cumbria, the children can come up, book it out, stay in it. We don't know what the lady owns. It might be a 2-bed cottage. It may be a 4-bed mansion. So, depending, is the room for the children to come and visit as often maybe as they would like? And get them involved.
Well, we've got a recent example, haven't we, of Sidmouth, an area that we've had cottages in, and people have bought it for that particular reason, haven't they? They're using it now as a holiday let, get all the family together.
That's right.
Staycations, the amount of people that now want that. They won't have them sort of.
It's that mix, like we did the same in Anglesey. Anglesey would be perfect for herself. One, obviously, for the kids to visit her. So I'm guessing, like we all do, we all spread our wings and move to different areas. So one, I think for, like you said, consolidate, get all the family involved so they know the strategy. And again, like you said, with Adam, is it a limited company? Would be the right thing, maybe. So it does get passed down to the children quite easily. Things like that. But
I think speaking to the expert in every field, we're the property experts, but then you've got to look at when we talk about the mortgage side of it, the likes of Adam, and obviously from a tax point of view, it's just going into it, exploring every avenue with the experts, isn't it?
Yeah, 100%.
We've just had a couple of questions come through on the question side. As well. Sorry, Harmy, I missed this one before we were looking at the chat section. So you've asked earlier, if you move a property from a company to another, do you have to pay stamp duty, any other costs?
I would think you probably do if you move in company to company.
Once again, we're not tax advisors, but my understanding is, once again, so you'd want to check, but my understanding is if you do move it from your own name to a company, you do. There is
or company to company.
Duty.
Unless maybe you sell it to the company. would that avoid stamp duty? So you're selling company
shares
A to
almost,
company B?
We've got a really
Don't
good
know.
company actually, haven't we, called Get Ground.
Yeah.
Yes.
Maybe Jason can put on the link there something to them. They can advise on that type of thing, Army. I think it's be useful for you maybe speaking to them on it as well. And Stephen, good to hear from you. Good client of ours. You've asked George House in Hull is on our website. Doesn't have off-street parking. Is this not essential? Andrew, you have been to Hull a lot recently, so it'd be silly to go to anyone else.
There is, I don't know if there's an NCP across the road, Stephen, but there is a multi-storey car park across the road, and I think it is £3 a day. It's not it's not extortionate. So there is no parking at George, you're right, but there is a multi-storey.
It's so central as well, isn't it?
For most of my clients, who I speak to, sold city centre apartments, and looking from a lettings point of view, and doing viewings in city centres. It's not essential.
It's not, and they wouldn't get planning, developers. No. If it was essential, they would really struggle, wouldn't they, to get planning on it? But they're obviously seeing it as a council as not an essential thing.
Well, if you look at Oak Court in Brearley Hill, that had to have parking because it's on a main road. There's double yellow lines. Opposite is a retail park. Parking is, I think, 3 hours limited or 2 hours limited. So there, parking was important. George, I don't think it is. I mean, you look at some of the developments in Manchester, 200, 300 units, no parking.
No.
I think
the rentals.
I think the basic answer to that.
Fantastic, aren't they?
I think the basic answer to that is look at the area.
Yeah.
We had the same in City Suites in Chester. You'll see that on the website as well. That's a development that we do manage. Train stations walking distance. Yeah. Public transport. There's a bus station, bus route right outside.
George is the same. Bus stations on that, or bus stops, I should say, on that road. Train station is a 5-minute walk. The guy I met there, he caught the train from London, 2.5 hours from London up there. Walked 10 minutes and he was at George.
And if you are an investor who's just detrimental, I want a parking space. There's things you can do. Contact the NCP, local NCP. If you're in a city, there's going to be some sort of NCP card.
And take a contract.
And you can take a contract to lease these spots for a year.
Was it Colwyn Bay or Anglesey? Anglesey, I think they took a contract with.
Colwyn Bay was
both.
Was it?
Yeah, Colwyn Bay and Anglesey did it.
The big one was, like you said, Mike, he wouldn't get planning. It was going to cause chaos in terms of parking and highways with them. So Jason just put the link up there to Get Ground so they can help with the limited company questions on that as well. Feel free to have a look at that afterwards. So let's move on to our next top trump, who is a 27-year-old professional footballer. Interestingly, this is actually based on one of our own clients. Obviously, we couldn't put the name up or anything about it, but it is based on a real-life client of ours who's doing really well. Now, clearly, he's a footballer, so he doesn't have an awful lot of time to spend on looking at property. Andrew, what would you suggest? He's already done well, but what would you suggest in this?
Actually, this guy's harder to find something for, I think, because he's got 300k. As opposed to the guy that's got 80k, I think you can sort of just move him somewhere. Like George, let's say, you've got 80k. George is a bit more too. You've bought into George. I think with 300, it's harder. His lifespan as a professional footballer is also very limited. So at the moment, he's probably on very good money. He's got a chunk of cash, but he's maybe at 27. He's maybe got, 8 years maximum?
If he's at Man United, he gets 20 years. Ronaldo's, 40 years old. I'm a United fan. It's quite painful, but
he's got a window.
His window's a lot shorter
than
to retirement than the average person.
Given the money he's earning. So he's got to make that money work.
But credit to him.
He's making it work at the moment.
Yeah,
he's got eight properties there. My thought would be diversification. I'm not quite sure what his 4 in Scotland are. There may be Edinburgh, there may be Glasgow, there may be city centre. I would probably talk to Adam, look to leverage that 300k, and I would probably look towards maybe furnished holidays, short term, the corporate let, and move away. Maybe he's around the country already, 4 around the country, so he's clearly not worried about being on his doorstep. I think I would look at furnished holiday because I think the tax advantages for him on furnished holiday, offsetting the loans he's taken. If you put 75k in, 75% loan to value, he's got another 300k. He could go and buy 4 potentially top quality furnished holiday accommodation.
Yeah, I
and get the tax
suppose.
benefit of it.
I mean, obviously mentioning Man United, he's got another 20, 30-year career. But I suppose, Adam, with finance with these type of clients, I suppose does it fall under self-employed as well, where people are working for themselves, or they've not got a long contract. So say, for example, if he's got 3 years, what would your opinion be on that in terms of finance?
So if they were a contractor or self-employed, it wouldn't actually be too much of an issue. It tends to be contractor, self-employed guys. It can either be IT consultants, obviously digressing slightly, or whatever sector they may be in. Usually it needs 6 months to run on a 12-month contract. So again, it's still achievable in the buy-to-let space because there's no minimum income requirement. If, for example, that client there has buy-to-lets in the background, so he's probably doing a tax return that would show some sort of income from the property, so that would substantiate any rental voids and allow him to be lent to. So it's just about playing around and being creative with whatever income that they currently have in the situation.
I think going back again and changing the mortgage market, if you were a contractor, my brother-in-law contracts, and he found it very difficult to get a mortgage because he was always on a 2 or 3 year term, and the lender would say, great, what happens in 2 years time when maybe your contract finishes and they don't renew? I think certainly for the footballer, because it's an income, isn't it, he's generating, as long as the income covers the mortgage, they will look at the affordability of that. So I think he's probably going to be fine. I don't think he'll have. I'm sure Adam will clarify that. He probably won't have any issues on financing on buy-to-let or furnished.
No.
I think for him to set his goal, isn't it? If he's got 5, if he's thinking he's got 5 years left to retirement, what's his plans after that? What income does he need at that point? And then us putting a strategy in place to achieve that.
And credit for him to looking at, because a lot of the time with professional footballers, they have agents, don't they, in between.
Yes.
That put clients off investing in property, mainly because they're probably getting money elsewhere that they can earn from it, rather than their client putting it into
linked up with other financial advisors.
So he's done it incredibly well, really. To do that.
Well, he's done everything directly, hasn't he? He's done the clever, the smartest way of doing it. He's doing it directly. Instead of an agent in between going, well, how much commission can I get out of this? Going for these different types of deals.
And I think all credit to the consultant that deals with this guy. It's the trust that person has in our consultant, that it's not just what can I sell, that quick fix, sold in one, great. It's a long-term relationship with him. He's got a 5-year, maybe a 7-year stint of earning substantial money. He may be fortunate, I don't know, and can he go into being a pundit, the next Gary Lineker type of thing, or into coaching, or unfortunately for a lot of footballers, that's it. Their career finishes, and then they've got to go and get a job. Well, his job could be then managing those properties. And once we talk about managing, he's too busy playing football. He's got to concentrate on his day job. That's why we come in as a company where we can offer that holistic management for him. The fact that dotted around the country doesn't matter to us. We'll still manage it. And if we can't, we will have to contact, in Bournemouth, we use an associate company in Bournemouth to manage the developments we have down there.
That's great. It's another secondary income, isn't it? There's a few Man United players that should be looking at getting a secondary income. That's me at the moment, like Pogba. Get for another webinar.
For another day.
It is.
It's another webinar. Man United.
We could have a week on it.
That's it. Rajesh just asked a question. Do you have a list of good tax consultants for property? We do have a couple, actually, can't we? That we can recommend across. Again, Jason might be able to put a link on there as well. If not, we'll send you something across.
I think some of that tax advice depends on what you're looking to achieve there. Is it, I'm going to buy one property in a company name? Have I got a portfolio? And oddly enough, different tax advisors might have different strengths. A bit like companies. Different companies have different strengths that they play to. And it may be,
S-tax is one, isn't it? That would be the capital gain side of it. So
S-tax, we talk about furnished holiday let with them, capital allowances with them, but they may not be the company just to go and do your HMRC tax return, income tax return. They can, but I would probably recommend get ground for something like that. Put it in a company, get them to manage your accounts for you.
Completely agree. Adam, I'm sure you work with different tax consultants as well. You might be able to recommend any firms or perhaps.
Yeah, absolutely. We certainly can. Like I said, it's one or two. It is a very niche area, and mainly for reputation for ourselves. We wouldn't want to put anyone in like yourselves as well. We wouldn't want to put someone in touch and a client in touch with somebody that we wouldn't trust. So it is a very limited pool on guys that we can trust to do a good job. So again, I can send them details over and you can pass them on, no problem.
Great stuff.
I think that's a valid point Adam was making there, that would we use that company? Would we have to trust in that company? It's not just, great, here's the name, use them, because it reflects then on us.
Yeah.
And
Yeah.
it's hard to make a recommendation, because I think by recommending a company, we're effectively endorsing that company. I think it's far better to recommend 2 or 3 that we have a good working relationship with, and let the client talk to those 2 or 3, because no one size fits all, does it?
Yeah.
So their circumstance may be better for company A than company B.
Well, we keep touching on it, don't we? Trust.
And
Trust is huge
immense.
when it comes to this, because obviously you can be, like I said, confused with agents, confused with you've been recommended. What is he getting? What's that company getting? And it goes back to the client. Well, I was dealing with Bob the Builder. It's a case of, look, we can't help you right now, but in terms of brokers like Adam, accountants set up the strategy and where we can fit it eventually. It's just having that honest approach with people and.
Sorry, Chris, I was going to say, and this is where the internet helps as well, isn't it? Like we touched on the start, you can find out so much information online now that perhaps, decades ago you wouldn't have been able to
find it.
to learn that.
I think talking of trust, it's something that we try and promote is, if you are in the UK, come and see us.
Yeah, absolutely.
I wouldn't say come and touch us, feel us, but come and see
Now I
us.
think post-COVID,
Come and see
That's
us.
another webinar as well.
Yeah. I think it's important for, personally, and again going back, I used to sell an awful lot into Ireland when the Celtic Tiger, as they called it, was rampant. I used to deal with some people. They would catch a flight in the morning, Ryanair, come over to Manchester, I'd collect them in Manchester, would show them Manchester developments, and then they would catch the flight home. So many didn't.
Yeah.
And they were spending hundreds of thousands, and yet they wouldn't come and meet me. They wouldn't come and see what we were selling them. They bought.
Yeah.
I always think, I won't say the world is a small place, it is, but the UK is small.
Yeah.
Come and meet
But
us.
especially a company like us that has the management side as well. So we don't just sell the property, we have the property management side. And we have the resale side, which is that you head up, Andrew. So we're there for the full cycle. So it's particularly important to build that relationship as well. We just mentioned there, Yogesh, good to hear from you. Another good client of ours has asked for the contact details of the tax advisor. And OJS is going to send it across to you and Jabir. Russell's just asked a question. Well, are you able to recommend accounting firms to assist with setting up structure for international buyers, please? Yeah, we definitely can. It probably is going to be Get Ground, I would say, again, would be the best company to speak to, Russell. But
there are a couple of others as well. It depends what type of structure you're wanting. Get Ground are very good. I would probably also talk to another.
Yeah, we'll have a think.
Depending on what you're doing, what you're looking to achieve in that.
I think the secret is with that, with the likes of Russell, is this evening, tomorrow, give us a call, drop us an email, and we'll speak to you. Yeah,
we've got a couple of clients actually who are accountants. Chris, you've got a couple there that not only buy property offers but have helped some of our clients.
Yeah, I mean, some of my clients are actually accountants because they sort of get it. Once you are an accountant and you've gone through, the ins and outs of setting up for a limited company. Yeah, once you've done that and you've got the taste of it, then as we've seen, even with clients who are not accountants, it just becomes a train, doesn't it?
They don't put emotion in.
No, there's no emotion.
My 2 good friends who are accountants, there's no emotion there. It's just facts and figures.
Yeah, exactly.
We'll talk about it later. That bottom line, that's the crucial thing to them.
Yeah. But we have more, Jabir, in answer to your question, other than Get Grand. So we will send some companies across after that.
You see Hazel typing as well. Hazel, welcome. Good client of mine, Parash, is answered the question there.
Yeah, what areas are any new projects are we looking at? Quite a few different areas at the moment. We mentioned Halifax before, the success that's had. We'd be silly not to look at other projects in there.
Exactly.
I know we've got a couple.
Especially with the 37 million they're spending in Trinity House. Halifax.
Yeah,
I think the big one as well, Parash, as you'll be aware with Halifax, is we use Halifax, the bank. I know it's been taken over by Lloyds now. Halifax does hold the HQ for that bank, so we because we already use them for our corporate let and short-term let properties. For us, it's a no-brainer. Of course, we want to manage that. Not just the investor earns profit, but we do want the management of that property as well. So, Halifax is a big one, isn't it?
Yeah, and we like to cover all the different sectors of the industry. So, in terms of student accommodation, I know me and Paul looking at one potentially in Portsmouth at the moment. There's big demand there for more accommodation. So, depending on the sector, we look at the demand and then choose the location. We're also fortunate now that we've got a lot of developers who come to us first and ask us, what are our clients looking for? And they go out and source properties. I've been in the company 8 years now. It wasn't like that at the start. We were going to them. So we're in a really great position, aren't we?
I think you're right there, Mike. You look at some of the developments we've sold where our input into that conversation has maybe tailored what they're going to build. They might have built 3-bed apartments, and we're saying, no, you want to build 2-bed and a couple of 1-beds because that will work on a short-term let model. And there are a couple of developers that are actually talking to us at the planning stage almost. So we're right in there at the beginning.
I think
Andrew, speak to the clients, aren't we? So we know what the clients want.
I think investors as well. I think they're under the impression because once you launch a property, you think that you've had it overnight. You've got this property. For Mike, I feel sorry for Mike because he spends months and months. They've got we've mentioned lease, service charges. I mean, these are all things, and I suppose Hayes will be aware of this, Parash as well. I'm not too sure about the other clients because I don't deal with them, but leases in terms of the flexibility on doing short-term lets.
Can we do short-term lets?
Can we do short-term lets on these leases? We've seen changes coming in with licenses in London, around London now. So these are things we've got to check. Not just so we're selling the property, but because we manage it as well. For the long term, for our business, we've got to make sure everything's by the book and we're not going to have any problems in the future. So.
And it can take months.
It can take months.
And because of planning as well now, there's a huge delays in the road. Developers getting planning through. So we can be looking at a project like Chris says now, but really we're looking at sort of September time for launch. So there's a huge time. I
talked to a national house builder on one of the panels I sit on. He reckons it is 3 years. From looking at the plot of land to getting the digger on it, it can be 3 years. And you think, how do you budget for that? And we were talking earlier, can't remember the client's name, apologies, about cost of materials. So they look at the plot today and think, I can build that round figure, 100K. I can build that for 100K. In 3 years' time, when they get the digger on, it could be 200K. But he's priced it 3 years earlier. And you think, how do developers work on that? And again, it's an indication of why there's such a shortage of houses. If it's taken 3 years, or property, not houses, but taking 3 years to go through that process.
I think I've seen stats saying that we won't build over the next 5 years and we won't even hit 50% of the level of houses we should build.
So, and based on that, how can prices come down? Isn't it? Based on that basic thing, it just can't happen because of the demand.
You've got inflation, you've got all these things as well that are actually increasing. Increasing the demand. I mean, we've seen it after lockdown. But I just want to step in, guys. I've got a good question from my client Hazel, which I'm hopefully you can help with, Adam. We're looking to set up a pension fund for a property limited company. Is it possible to set up a SAS instead of auto enrolment into a normal GVT pension? I know you're not an accountant, but if you can help my client.
Yeah, I think Hazel, what you're saying there is instead of an auto enrolment as a government pension, if I'm correct in saying that, I think if you're wanting to set up a SAS, or there's also a SIP as well, it's the same thing. And can you lend in to a pension fund or a SIP or a SAS? The simple answer is yes, you can. It's 50% loan to value, but it is only commercial property only, and it is full true commercial. So it would need to be either a retail shop or a warehouse or whatever it may be. It'd have to be true commercial at 50%. I think that is what you're asking, but do type if it is different to that. But yeah, that's it. So you couldn't buy, a buy-to-let or a holiday let in a pension fund such as a SIP or SAS.
And Jabir, that's a common question we get asked a lot on student accommodation as to why it's a cash-only buy and you can't get a mortgage on it. The simple answer to that, Jabir, is to do with the size. So typically student accommodation is studio, self-contained apartments, which are more often than not below 30 square metres.
18, 20 square metres on average?
Quite often, and lenders won't look at those sizes. So that's the problem. But having said that, Adam, you've had some success recently, haven't you, for a few of our clients that have got more than one student property that have actually been able to refinance and pull money out of their portfolio of student accommodation.
Yes, absolutely. Interestingly enough, I've just seen his name, but one of our brokers, Tyler, you're actually on. He's on the webinar here. So I believe, I don't know if it was yourself, Tyler, or if you're aware of one of the guys in the office. So if you maybe want to type on that student accommodation point, it'd be quite nice to hear from you if you don't mind, mate.
It might have been Marco, was it?
Was it Marco?
I think,
Yeah.
yeah, it
So
was Marco that had dealt
oh,
with
was it Marco?
but
Fine.
yeah, I know
Yeah. So
our particular client had 17 studio apartments, and
yeah, Tyler is typing. He does sit behind Marco, so he probably knows what I'm referring to, actually. So, apologies. I'm up in Scotland, so I'm not always in the office every day, to be honest. So, it'll be interesting to see what Tyler says. Okay, noted. Commercial. Yeah, that's fine, Hazel.
Those fingers.
Yeah, he's like this, isn't he? Yeah, that's it.
It's huge, though, isn't it? I mean, buying student property. These people who have been buying them cash have now got, you've got a few of them at least. At least there's, like, for example, Adam at DNA, there's that option to exercise, get some equity out of it. I mean, we all know, I'm not too sure if you've bought one, GB, or you're looking at buying one, but the returns are phenomenal, aren't they, for student property?
And they've gone up in value, haven't they? Quite
well, the rents come out of the student loan. So, as long as you're buying in I suppose the research would then be on the area. What are the university capacities? For example, Preston, we've seen 200 million invested. New educational wings, engineering sector, media hub. So these are all increasing the student numbers. And if you're on the campus or close to the campus, it's not going to go anywhere, is it? So,
Yeah, and a quick question for you guys. When you mentioned about the refinance on the student accommodation, was that actually a flat that you were referring to, or a studio that was refinanced, or was it more, say, a HMO or something? I'm not too sure.
Yeah, they were studios. So it was a PBSA block, Adam, on that. I think it was about studios in the block, and like I say, our client had 17 of those studios in it. So
I think I do think that the more you have, or if you had, say, a multi-unit block, it can be refinanced. Tyler, it would be interesting to hear from you on that.
Football on, hasn't he, Tyler? I know what's happening. City games on.
Yeah, that's it. Yeah, that's it. So yeah, it would be interesting to hear from that. But yes, that's. Short answer is we'd have to look at everything holistically, and there's always a chance. We pride ourselves on giving everything a go, and if we can't do it, not many others can have a look at it, really.
Yeah, that's it. And Jabir, just going back to your next question, please. If you buy one student off plan, then one can get a mortgage. Yeah, it'd be very unlikely you'd be able to get a mortgage. They are cash purchases.
Yeah. I mean, if there was, there's probably only one lender that springs to mind. The rates would be astronomical, and then it comes down to, is it cost effective? Probably not.
Yeah, so you might want to look at.
So I suppose, like anything, I mean, look at the transitions we've had from short-term lets and holiday lets and traditional buy-to-let mortgages. The rates were, I think when we first started out, when I started out years ago, it was like 6-7% interest rate for a holiday let mortgage, and 2.8%, I think, for a buy-to-let, and those, as you can see, they're starting to compete quite.
Pretty much the same now, believe it or not. Yeah.
Yeah, I mean, exactly. Yeah. So, I suppose with student, once that door will open, it's going to be like Pandora's box, isn't it? There's going to be so many competing. There is a huge market for it, isn't there? For finance with student. I think, again, Jabir, touching on that, you've got to think there's facilities on the site as well. You've got gymnasiums, you've got cinema rooms. It tends to come with stuff like that. So it's a commercial property. Which does make it a little bit more difficult, especially if you're trying to get a traditional buy-to-let mortgage. Yeah, it's not residential, is it? So
and it'd be interesting to hear your full story, Jabir, and we maybe can book in a consultation afterwards and have a chat on that, because we'd like to know your budget, that type of thing, and it might be student accommodation isn't really the right sector for you. So let's maybe book that in afterwards, Jabir.
Definitely.
Yeah.
Great stuff. Right. Where were we? So the next guy we have, 34, no children, £25,000 cash. We often get asked, don't we, from clients, of how much money do we need to invest in property? What's the minimum budget? I know you hear it all the time, just because you're constantly saying to me, we need a development with this level of price.
The cheaper, the better. That's the sort of thing. But I do deal with a lot of investors who are questioning around, how much money do I need?
Yeah.
The short answer is it depends on your strategy again. I know this guy said, he's in rented accommodation. He's got £25,000 to invest. Now, we've seen what the market's done. You can still go out there and buy a terrace house for £30,000-40,000. We know what the areas are. I'm sure investors or clients that are looking at this have typed in on Rightmove, cheapest property to buy. We all do it. But sometimes you can fall into the transition of tenant profile. Some of us don't research that. Landlords, as much as you can buy a cheap and cheerful property, you've got to look at the area. You've got to look at the tenant profile. Something we've got to obviously heavily look at on our end because we manage it.
Yeah.
Now, the last thing we want is a cheap and cheerful property. We manage it, and it's going to be nothing but a
You can't rate it. If you can't rent it, you've got no return.
And again,
It's not an investment anymore, is it? It's a liability.
Yeah, and I would say realistically, for that type of investor, if you are looking to invest, your starting budget realistically, you want to be hitting around the £130,000 mark, because what that's going to do is going to put you in town centres. It's going to put you, city centres, if not just the outskirts, which will put you in sort of the regeneration loops. Ideally, £25,000. I don't know what mortgages are doing. Can people get them on 20-80% loan to value? The traditional way I've got in my mind is 25% down.
I always think
absolutely.
35,000. Yes, he's kind of on the cusp.
And sometimes the advice is, look, just wait a couple more years, save up a little bit more, and you might buy something even better. I've often heard you guys say that in the
speak again 6 months. Let's keep in contact. But time isn't right to do it now.
We all do. We all want to. He's got, for example, if I've got the £25,000, it's hard. That's someone saying to you, you've got a little bit longer to save. But I say all the time, Mike. If you're not ready, I'm happy to tell you you're not ready. Give it 6 to 12 months, or if you are looking at off plans and things like that as well, you can factor that in. Will my budget increase by that point?
And you don't maybe necessarily want to put all of your money into it. Property's a brilliant thing. We wouldn't be on here if it wasn't. But there's other things to think about as well with families. So you don't want to put your whole life in.
Also, for that guy, is it better to buy in a limited company than in his own name? Because the assumption is, and it is an assumption, he's a first-time buyer. So if he buys a buy-to-let, that will use his stamp duty allowance. So when he comes to buy his own home, and one home's maybe 150, 200k, he'll be paying an awful lot more stamp duty. So is it more preferential to buy it in a limited company? And that's, I think, where before you commit, get advice. Yes, look to buy the property, but then go and talk to the companies we're talking about, an accountant, a tax advisor, Adam, get the advice you need and work out the best. And it may be that you buy it in your own name.
Take your time doing research
and you maybe don't worry about the property in itself at the first point. So have a chat with the likes of you guys on it. And
I hardly ever talk about a specific property on the first call. It's like, what advice do you need? Is it accountant? Is it mortgage? What's your budget? It's normally 2 or 3 calls before we start looking at the exact property.
Well, exactly. It goes back to the point of people being confused, people being worried about getting on the phone and thinking, am I going to be sold to? Am I going to be doing this? It is all about the strategy. It's all about that person, what they want out of it. I mean, again, I want to bring you in on this one, Adam, because I do get a lot of investors that are in rented or with, as we said, we'll go back to the younger generation now looking to invest a lot more. If they are in rented, let's say they are employed, guessing they are employed because they've saved that money up, or even if it's been inherited, where do they stand on getting a buy-to-let mortgage if they don't already own a property? Does that affect them? Does that affect interest rates?
It doesn't impact interest rates because there's quite a few lenders that have come into this space now. So what it's called is first-time buyer, first-time landlord, or FTB or FTL. What that means is there's a smaller pool of lenders that will lend to them. Same rates. It's not loaded or anything. But what is looked at is for example, if somebody or one of the guys were looking to buy a £300,000 property on a £25,000 salary, a lender would get nervous with that and probably decline the case on what they called not a very technical term, but a backdoor residential, thinking they're trying to buy it to move into it. However, if it was within reason, it's £100,000 property, as you alluded to earlier. And it's a £25,000 salary. It's only a 4 times income multiple, so we could lend to that, no problem at all. So it's just about being sensible with your first purchase, because you wouldn't want to, buy a 250k property for your first rental property with, your deposit. You'd probably be buying a residential, I suspect, for that. And just coming back to your earlier point, Chris, there are 80% mortgages. There are actually 85% mortgages, not necessarily for first-time buyer, first-time landlords. But the rates are higher. So again, it comes back to the point, and thank you for commenting, Tyler. It's really useful. As suspected, there is one lender on a premium rate, but and some without a minimum, but not in the short-term let space. But again, it's then working out your cost margins and the margins of the deal. And does it work for you if you're getting 500 quid rent, but you're paying a 7% interest rate? Probably not. And I think that's the honest conversation that we have with some clients, that we turn them away because it's not good advice, and that's what it's all about, I suppose. So hopefully that's useful to people to hear that.
No, thank you, great answer. Thank you.
And Tracy, you put on there, can we be sent a recording? He missed it due to the doorbell ring. You should have invited them in, Tracy, to watch the webinar. But yeah, of course, we'll send them across replays. Yeah, that's it. So I think we will do just one more client on that, and in particular this one, because this is an overseas client, and we work a lot, don't we, with overseas clients. And again, it touches on the mortgage side of would they be able to get mortgages. Have you seen a lot more, Ad, in the last sort of few months of overseas clients?
Massively, yeah. In the last probably 2 to 3 years, the sector has just emerged massively, as much as the short-term let space, because more and more specialist lenders now, or challenger banks as they're referred to, have seen the opportunity, and a lot of foreign nationals, as it is classed as, or even expats, are wanting to invest in the UK, and more lenders are just coming into the space. Literally month on month, we're getting new lenders that are cropping into it. So, yeah, it's a very emerging space that just seems to be going one way, and that's evolving, which is really good because it drives down the rates.
And Andrew, I know you deal an awful lot with overseas agents.
Yes, yeah, very much so.
So you see particular countries, don't you, that suddenly pile into the market. So you're probably best bet.
Adam's right. Go back 5 years ago, and an overseas buyer trying to get a mortgage. No. And it's still hard to a degree, because one of the key things that the lender wants is a bank account, and not all lenders will automatically give you a bank account with your mortgage. Some are forward thinking and think, yeah, you need a bank account to have the rent paid into. We want it to stay in the UK as opposed to going overseas, because if it's in the UK, we have a better understanding you might pay the mortgage out of it. What sort of rates are we looking at, Adam? I would assume we're looking at what, 60, 65% loan to value?
No, actually, up to 75.
So you think at 75?
Yeah.
Certainly 65 to 75. Why wouldn't a bank lend? The equity in the property is there. You buy 300k. You've got the bank's got 75,000. If you're looking at a very mercenary type of scenario, they've got 75,000 to play with. Why wouldn't they lend? But it's only recently that they
and the lenders know, as we know, that the rental market is huge, and that we get a rental property on, and it's rented out that day. The yields are typically 5-6% on a standard AST.
I mean,
it's the rental market's booming. Well, that makes it safe lending, doesn't it?
Yes.
It's I've actually got a client in this situation, actually from Singapore. Singapore's quite popular with UK.
It's a nice country.
It is a lovely country, yeah. But just going back to that, I think what's important, a lot of them overseas investors, what they tend to do is buy them cash. Does that make it better, Adam, if they already own a property in the UK as a buy? Is that something they can use as leverage to sort of move on?
Yeah, absolutely. The more they own in the UK off the bat, the better. Because a lot of clients can sometimes buy on a bridge if they don't have the cash, or have a decent amount of cash but not enough to buy it outright. So they potentially buy on a bridge to buy that first one, or pay a real premium on the first property. But once they've got that UK footprint, and you're absolutely right, the bank account is key. But once they have that UK footprint, the credit profiling, one or two properties, the rates start driving down massively. So yeah, I couldn't agree more with you there that having one or two is key.
But what a great sign we have overseas clients that choose the UK to invest into. It
Yeah,
shows how popular it is. It's not just
Huge
ourselves.
confidence in this. They like the stability of the UK economy, well, to a degree, and until the last few months.
Yeah.
But they like the UK.
And these clients have not just picked it out. These clients are,
Well, they could go
savvy
anywhere,
people
couldn't they?
who've done their research.
Yeah. You think if that client has got 300k cash, he could buy in America, he could buy Germany, France. They like the UK.
Yeah.
They
You've got a
like
solid
our-
track record. They can go back, years and years, in terms of what
a
the
lot
prices
of
then.
overseas law is based on English law, isn't it? Like of Israel, Kuwait.
Yeah.
It's English law, so they understand the gist of it as to where it's coming from, and they trust the English legal system or the British legal system.
Yeah.
They have great confidence in it. I think it is actually quite rewarding knowing that overseas people wish to buy into the UK, because I don't know about yourselves, but would you go and buy in Germany, France? Would you have the confidence to do that? I don't know.
It just comes into it. Trust is huge, isn't it? Especially with overseas clients. It's about doing the research. We like research to our clients. Don't just look at the property and the area. Look at us as a company. Check how long we've been running in the industry. We've got company accounts. We've got things like that. We're not just up and running over the last 12 months, are we? So, and that's why we do what we do, I suppose, on the webinars, to sort of bring people in to interact and make this a little bit more comfortable. It's not just about flogging property, is it? It's about what suits that person as such. So yeah, I think with him, I'd want to know what he bought as that first buy to let. I mean, with my client from Singapore, they went for one in Birmingham. And again, buying cash, that was the idea, Adam. That's why I brought you in, because they just bought cash. They didn't want to get in the hustle and bustle of interest rates. They sort of knew they were going to be charged a premium. So this went straight in with cash, get that footprint, like you said, get the UK bank account. And then the idea is to sort of leverage.
Exactly. You look at this chap in Singapore, sold a lot into Singapore, Hong Kong, Macau, China, Kuwait. When I was selling it, it was always on an AST. And I had a lot of clients saying, can I come and use it for 2 months? Not really. It's on an AST. What are you going to do? Serve notice on your tenant, get them to move out. You spend 2 months in it and then have to find a new tenant. On short-term lets, just book that 2 months out.
Block it out.
And a lot of them, Manchester, Liverpool, Birmingham, some of them, I want to go up to the Lake District. I've never been to the Lake District. I want to go into the Peak District. Why furnished holiday let? Block it out for 2 months. Come and have a wonderful time in the UK, July, August. Some of them actually want to come in sort of February, March, because it's cold and they're not used to the cold or the rain, and they love it. Short-term lets has opened the market up for them significantly, more so if Adam can finance it for them. That 300k, they might only have 200. Can't afford that. The Sidmouths or the Kennecotts, that type of thing. Well, now you can finance it. But crucially, the 10 months that you use it on short-term let or furnished holiday will fund the mortgage and fund your holiday to the UK. Make it work.
Absolutely. So, sorry, JB, you've come in with another question there. Can I use Lombard Finance to buy a buy-to-let by borrowing or getting a mortgage on my share? It's another one for you, Adam.
Yeah, sorry, JB, I'm not 100% what you're meaning referring to Lombard Finance. But just coming back to your previous point on the limited company, because I will just quickly answer that. I did touch on it briefly earlier. A trading limited company, yes, there are lenders that can lend to it. It's just a little bit more restrictive, and there's a few more in the commercial space because they will look into a little bit more detail on that as a commercial investment as such. So it doesn't need to be an SPV, but an SPV, if you are buying a buy-to-let or a short-term let, is a lot easier to get finance for in terms of the application. So hopefully that answers. But when you say, can I use Lombard Finance to buy a buy-to-let by borrowing or getting it, could you just clarify that, please, Jabir? That'd be great.
Might be worth as well. Adam having a chat with Jabir after this.
100%. Yeah, let's have a chat, Jabir. Yeah,
that'd be good. Yeah, to set that up separately on there as well. So let's move on and just kind of summarize really of what we've discussed and the things to watch out for when looking at investing in property. So these are some of the do's and don'ts. So it's important to have a plan, like we discussed. So a lot of times when we do the consultations, we want to know what their end goal is, like we mentioned. Ask plenty of questions. Make sure you're invested in what the sector that suits you on it as well. Is a particularly good do, isn't it, on that front. Don't be hasty. Don't forget about the bottom line. That relates to the same point of, why have you decided to invest in property? What's your end game? Is it for inheritance, passing property on, that type of thing? And that will then depend on what these guys recommend.
I think it's just exploring every avenue, doing your research.
I think, that bottom one of the don't cut corners, don't be cheap. Get proper advice. Take proper advice. Tax advisor, lawyer. Get the information you need before you commit. Because one of the clients there was asking, can I transfer my personal name into a company? You can, but it's going to cost you. And have they maybe had advice, or circumstances change? So I don't know the client's situation, but take advice.
Well, I think we would like to
pay for good advice.
I think we would like I like to say us four here have probably got a really good knowledge of mortgages and a really good knowledge of tax, better than the average person. But I wouldn't advise somebody on tax because I'm not a specialist.
No.
I think it's important for everyone who's obviously watching this. It's free education. This is
Yes.
It's all free education. When you're getting on the phone speaking to the likes of myself, James, or even anyone here at Residential Estates, this is all free education. And I think people do forget that sometimes. Using the website as well, we've got tons of information, guides on different areas as well. We've got Jason and Rich who head up the marketing side of the department. So again, blogs, news reports, it's all free education. But you're right, Andrew. I think the right advice for the right investor, knowing what costs that you're going to be sort of incurring when you do invest in a property, and these different strategies, it can be confusing. So
it can, and goes back to what I was saying earlier about the Irish guys not coming over. The flight at the time was like £30. They were spending $150,000 on an apartment with me, and they wouldn't spend a day of their time, admittedly, in a £30 flight. What do you think? Well, you're taking a hell of a risk because there was no Zoom in those days. It was telephone call. I could have been anyone, couldn't I?
But and he's speaking to all the different contacts as well. I think you touched on it there, Chris. So who is going to be managing your property for you? Don't just speak to the sales consultant. Speak to the people that are going to manage it, or whether that's us or whether it's a different third-party management company. You need a relationship with them going forward,
and trusting the due diligence behind it, Mike, as well. Like you said, these are the properties, especially the properties we deal with. We're not just a case of rang the owner now and gone, we're going to sell it tomorrow. It's just not like that, because we basically handheld the client all the way through it, and we manage it at the end. It's got to make sense, not just for the client, but for us as well. So,
and when we're choosing developments, we always look at, would we invest in that development ourselves? That is the key question.
Do we want to manage it?
And the answer has to be yes. For us to be able to put that to our clients, we have to be able to say, we would confidently invest in it as well. So it's really important on that front. So just a few common misconceptions that we often hear from clients. One there, being a landlord is hard work and I don't have time. I can understand that point. If we go back to the likes of Bob the Builder, I suppose, earlier on in the webinar, that would take up a lot of his time. But an awful lot, certainly the property that we sell is very hands-off. Certainly my property that the company manages, I have nothing to do with it. I just get the income at the end of each month, which suits me. I haven't got time for all of that. But we do hear it a lot, don't we, with people fearing that there's a lot more work than
I think that leads to me with getting a good agent as well. Getting a good agent and a good agent to get you a good tenant, and the better the tenant, the less.
And manage the tenant. That's what you pay them for. If you pay a fully managed service, you want them to manage the tenant. You don't want to call it.
I think investors.
The light bulb's gone.
I think I agree with you, Andrew. I think it's important that an investor, no matter who they're going to team up with as an agent, you want to know that the property. You want to know that this agent that you're teaming up with, yes, it makes sense for you as an investment. But does it make sense for the management team? If they're not earning any money out of it, it's quite alarming, isn't it? So there's got to be a strong case of a lot of due diligence behind in the background. And the big one we do get is the prime city centres are saturated and oversupplied. It's a no-brainer. I think people do miss this quick and simple tip. If you go on Rightmove, if you look at, for example, the city centre of Liverpool, if you click on a 1 or a 2 or 3 bed to let, finding out what is available will give you a good idea of if it is saturated, if it's not, if it's undersupply. If you look at, for example, we did it at 1 London Road, didn't we? As a student investment, if you look for a studio, there was none available. Click on, one or a studio to let in that area within a 1.5 mile radius, and it'll give you a good idea of if it is oversupplied or if it isn't. So I do agree with that. Some cities are,
Yeah.
Some cities aren't. That's a quick and simple tip to find out.
And what a great message from Tracy then. A really good idea actually about mixing with like-minded investors such as Bab and Hazel that we've seen pop up this evening who've invested in property. And I think it's a good idea of people learning from other investors, what they bought, what they did well, maybe what they regret slightly with what they purchased. So yeah, really good point, Tracy. And I'm glad you found this useful. So perhaps we can put you in touch with those two. Jason's typing, so he'll confirm if GDPR allows it.
Yes. I think the longer you deal with property, you're going to have great success and you're going to make mistakes. And I always think we all make mistakes. It's learning from that mistake and not doing it again. That's the key thing. Yeah. But talk to people that have invested. And I would qualify that. There was an adage, one of the trainers I used to work with, quite an obnoxious guy, but he was talking, you're talking to the client on the phone, and the client says, I don't want to buy it. I was talking to my mate in the pub. Were you? Okay. What did your mate do? He's just a mate. Okay. How's your health? My health's, well, I've got a bit of a heart problem. Have you now? Did you talk to the mate in the pub, or did you talk to the cardiovascular guy? I spoke to the cardiovascular guy. Why did you talk to the mate in the pub that is a good mate, but doesn't know anything about property?
Yeah.
And I think it's talk to people, but listen to what they're saying and take on board what they're saying. But we've spoken about the internet. There's an awful lot out there. Some of it's very good. Some of it is twaddle. And I think, just chuck me as an aside, you go onto Amazon to buy something on Amazon, 5-star reviews, 1-star reviews, and which is right. Some of the reviews are, the thing is marvelous, set the world alight, and then you get this one review that is totally reverse. So take everything with a
learn from the experts in that field, the experts in that field. So we should say.
A big one as well is that when you mentioned my accountant client who bought up in Eden Grove was a site that we've got. I think we've got 1 or 2 available still there at the moment, or they're coming back on the market. So I had a client who bought there as an accountant, and we've actually got a testimonial. I'll have to check with Jason if that is on the website. We've definitely, it's on YouTube on our YouTube. But it's a full review of my client as an accountant, the ins and outs of why she's bought a property on short-term lets in Eden Grove, and obviously diversify. They've actually gone on to buy, for example, student property as well, to sort of diversify instead of buying all in one area. So things like that we can help you out with as well. If you want to hear from a client, that's something we can organise. To give you sort of a peace of mind is, what is this property? Do short-term lets work as well, just so you're not hearing it just from us. So yeah.
And we've often shown our own properties that we've invested in, haven't we? We've got an open book of here's the figures and stuff of it. So, we certainly believe in what we do on it as well. Right, guys, I think that is about it really for this evening. Adam, I want to say a really big thank you to you for joining us this evening. Really appreciate it.
Yeah, thanks for having us, guys.
Yeah, some really good advice, and obviously we'll put links to yourself. People are welcome to have a chat with you as well on it. Guys, thanks very much for joining us this evening. Really appreciate your input as always. Hope everyone's enjoyed it. Hope you found it useful, and thanks for popping up and comment as well. It makes
thanks for interacting, guys. It's been
it's really nice.
Interactive. Really nice to get lots of questions.
Thanks Rajesh, thanks Russell. Thanks Babs, loved it. That's what we like to hear. We expect you on the next one, Babs. Next month. We try to do a monthly, don't we? So we do different topics based on what's out in the marketplace as well. But that's really appreciate all the comments coming through. As we said before as well, the replays will be sent across to everyone, I believe. That's what's the webinar. So if you missed a bit of it, if you nipped off to watch the football, then you can catch the whole lot.
Nobody should be watching Man City. No one.
Well, they can't watch United, can they? Great stuff. But that's brilliant. Yeah, Alan, you've mentioned there you missed some of it, but you'll catch it up on afterwards. Yeah, we'll send the replay across so you'll get to see it. And Yogesh, good to have you on as always. It's a very good client of ours as well. So thanks everyone. We will be in touch very soon. We'll have a webinar next month as well. If you ever want to book in a consultation, by the way, I should say, do get in touch. We'll put a link across, I believe, there on now, So where you can book it in with one of our guys, talk through your own situation, like what we did tonight, but do it privately with one of these guys, and they can give you some advice.
Cool.
And do whatever you want with that
Yeah,
advice.
give
It's
us a
free
call.
advice, like Chris mentioned earlier. So why not use it as well? Right, I'm going to stop talking. So thanks for joining us this evening, and
Thanks,
we'll
guys.
speak to you all soon.
Superb.
Thank you.
Thank you. Take care. Cheers now.